Hey guys, Brian Burns here with the Master Key Group at RE/MAX Downtown, and we are talking about the fundamentals of real estate investing. Particularly today, we are going over a question I get asked all the time. Brian, what is going to give me the best return on my investment? The stock market or real estate? Okay, now in that question, I answer very easily because it's both. Both of them have a great place in your portfolio. You never want to have all of your eggs in one basket. So today we're going to go over the pros and cons of each. All right, we'll start with stocks. Now, the big thing about stocks is that it can be hands-free. Obviously, you should take some guidance on it. For instance, I use Motley Fool. Every week, they kind of give you some stocks to purchase, and that's it. I think I pay like 50 or 60 bucks for the year for that, and then I just, kind of buy what they tell me, and they've kind of never steered me wrong. So I'm really, I've had some great success with that. You also have no carrying costs, okay? So generally speaking, stock portfolios, they don't charge you any kind of fees to have them. They don't charge you any trading fees. Now, if you have somebody who's managing your portfolio, of course, they are going to be charging you. But if you're doing it like, like I just said, taking some guidance and then, rolling with it, then it shouldn't have any carrying costs. Now, and the other thing is it can be done in a tax-deferred account, okay? So if there's one thing we don't like, it's paying taxes. So what happens is this: if I have $100 from a paycheck that I want to put into a retirement account, this is generally what it's used for. So I take $100 from my paycheck, put it right into my stock portfolio. Now, if I don't do that, and I get that $100, say I get a 20% income tax or 20% taxes. So now I only have $80 to then put into the market, right? So now that gives you a unique opportunity to invest more earlier, okay? Whereas with real estate, you can't do that. You can't say, well, I'm gonna take $100 per paycheck and then I'm gonna put it towards purchasing a property. There's no special tax deference for that. You would pay your taxes on it and you would just put it in a separate savings account, okay? But real estate definitely does have some very good tax advantages though. Now, the other thing is it's easy to diversify. Where a home, you can diversify real estate. You can invest in some condos, you can invest in some short-term rentals, maybe some single families, maybe some townhouses, but you're still in real estate, okay? Now with the stock market, it's great because you can go into technology, you can go into medical, you can be a part of all of these companies, Apple, Tesla, Google, all of these companies, and you can diversify your portfolio for a lot less, all right? Now you have easy access to capital. That is a very important thing. So say you have a $50,000 portfolio, all right, and you need $10,000. Maybe you want to pay off a car or something like that, okay? You can sell $10,000 worth of stock. You can sell it from all different places where you own, and get your $10,000 out in about 2 days. Now, real estate, unfortunately, is an all or nothing transaction. If I have $50,000 in equity in my house, yes, I can do a HELOC, a home equity line of credit, but it really doesn't make sense to do that for only $10,000. I would then have to sell my asset to collect $50,000 just for the 10 that I needed, okay? So real estate is an all or nothing. Stocks, you can do a partial sale, all right? The other thing is it's a low point of entry. I can take $5 and become a stock investor today, okay? And I could take $10 from my bank account or $10 from a paycheck every week, and then I can invest more and more and more. Unfortunately, it would take you a pretty long time to get to the point of being able to invest in real estate, $10 at a time or something like that. So it is really an easy point of entry. Now, some of the negatives, much more volatile. I think we've all seen that. With the coronavirus was a perfect example. Over several days, the stock market dropped almost 30%. Okay, the housing market was completely unaffected. And that's because the stock market gets traded hundreds of millions of times a day. They have computers trading these stocks and doing all these things. Whereas a real estate is a lot more slow to react to the market. So with real estate, you have to get the home ready. You have to put it on market. You have to wait for closing. That can take 30 to 60 days to do this. It's not an easy, you click sell and then it's sold, right? So that's the big thing about stocks, is that it is very volatile. I mean, there was one day where Elon Musk tweeted that his stock, he believed it was overvalued, and it dropped 10% in a day. You can lose thousands like that, So The other thing is you actually don't own anything tangible. Should something happen to the stock that you own, the nice thing is you are diversified, so hopefully you don't want to invest all of your money in one company, but should something happen to the stock market in general, you don't actually own anything tangible. You can't sell a stock. You can't withdraw it and then take your piece of paper. Where on the other side, real estate does have tangible assets. Say for whatever reason that people decide, you know what, houses, we don't like those anymore. No one's living in houses, right? And no one will buy your house. You can still sell the electrical wires. You can sell the appliances. You can sell the bricks. You still own the land. So there's something tangible there forever. Okay. Now, the other thing is that it is a slower path. A lot of people think, well, the stock market on average grows about 8 to 10%, like a well-done portfolio grows about 8 to 10% a year. And then you look at real estate and you say, well, real estate only grows 3.5% a year on average. And then you start to think, well, if I had $100,000, why wouldn't I just invest it in the stock market? I'm going to get $10,000 a year off of that, and it automatically compounds. Well, remember, when we're buying real estate, we're also able to borrow the bank's money. Okay, so now I only need 20% down. So with that $100,000, I have $500,000 in buying power. Now, a $500,000 house goes up 3.5%. Okay, now I'm at $15,000, $17,000 gains a year. Now that is much more tempting than the stock market. Now obviously you have to pay to access this. It costs money to sell your home and everything like that. But the nice part about the bank, if I was a business investor and I invested in your business, I want some of the profits. I don't want you to just pay me back. The great part about borrowing money from the bank with real estate is they don't want any of your profits. They want you to pay them back. You pay interest, obviously, but there's no paying early. Early termination fees or anything like that. So the bank doesn't want any of the money. If you sell this house, this $500,000 house for $750,000, they don't want 10%, or they gave you 80% of the money. They don't want 80% of your returns. They just want you to pay them back. Okay. Now, you have to pay capital gains annually. Now, this is for people who are not day trading, but are frequently moving their stocks around. So, for instance, a great example: if I bought in the dip, which a lot of people did, they saw, wow, what a great opportunity to basically you could have thrown a dart at the wall and anything you hit was going to go up. So what happened now is, say I put $10,000 into the market and say I doubled my money. I did very well. Now I have $20,000 and I said, you know what? Okay, all these stocks, these were kind of like opportunity stocks. I want to get rid of these. And then what I'm going to do is I'm going to diversify my portfolio for a longer term. Okay. Now, a lot of people think, they say, well, in real estate, if I sell my home, and then I buy another investment property, that's a like-kind exchange. Well, in stocks, that is not what it's considered. So what happens now is you've sold all those stocks. You have to hold them for 2 years. Otherwise, it's a short-term gain. Now what happens is you've gained $10,000. We started off with 10, ended with 20, sold it. Now we've spread that $20,000 out throughout the market. But guess what? Come the first of the year, you're going to owe taxes on that $10,000 that you earned, even though you have bought like kind by buying more stock. Okay. Now, the other thing is you can't leverage the bank's money. I can't take $100,000 and say, hey, bank, why don't you give me $400,000 and let's just take this 8 to 10% to the moon, right? You can't borrow any money to invest in stocks. Okay. Now, let's talk about real estate. Now, real estate has a much higher ROI, return on investment, and that is due to a couple different factors, and we'll go over those. Now, you can use the bank's money to buy more real estate. We already talked about that. Now, you have lots of tax advantages. A lot of people don't realize that everything down to repairs, upgrades, things like that, those are all tax write-offs. The other thing we have is what we've been talking about before, is that amazing 1031 exchange. I can now continuously use that asset and sell it and then buy more real estate without having to pay capital gains tax on it, unlike a stock. Okay. Now, it is a tangible asset. We talked about that. You can break it down basically into pieces and sell it. Now, you can customize your asset for more returns. This is a great thing that people use when they flip homes. And it's not just for people flipping homes, but say you buy a home that's really just, a crappy house, and you can maybe rent it out for $500 if you could even get anybody to live in it. Now say you invest, some money into it, now you can rent it out for $1,700 a month, and the value of it goes up. Say you put $30,000 into it, now the value goes up $80,000. There's nothing that I can do with a stock to make it more valuable than any of the other shares. I can't say, well, hey, look at this Apple share. It's got a brand new kitchen and a new roof, and then the AC is only a year old. It doesn't. That the stock is the stock, and that's it. It has nothing different about it. Whereas this asset, you can change it to make it more valuable and be able to kind of customize it. Okay. And then the other thing is the increase in value while producing income. Now, stocks, they do have dividends, but I think Apple pays out like 80 cents a share or something like that. So in order and their prices are like at 120 right now, okay? So in order for me to get $8 a quarter, that's every 3 months, I would have to pay $1,200 I would have to buy $1,200 in Apple shares. If I wanted $800 every 3 months, I would have to spend $10,000. No, I'm sorry, I would have to spend $100,000, okay, in order to get $800 a month, or sorry, $800 every 3 months. The great part about this is that the house goes up in value yearly, generally, but every month you're making $400 to $600, $700, $800, $900, $1,000 a month. I mean, I have some properties that are cash flowing at over $1,100, okay? Now, some of the negatives is that it can take time to find your property and to manage it. Now, this one's pretty easy to get around. If you don't want to manage the property, you just hire a management company. Obviously, it cuts a little bit into your profits, but you have somebody else who's managing this for you. The last thing you want to do is be at your kid's birthday or in a big meeting, business meeting, and you get 15 missed calls from your tenant because the water heater exploded and is flooding your whole house, right? And you're losing money by the second. And then as far as like finding these properties, that's what I do. I sit around most of the day looking for, I spend a lot of time looking for these properties for my clients, and also for myself. Now, the other thing is you are liable for payments and tenants. So first of all, you have a legal liability to tenants if something was to happen to the property or to the tenants, but you also have the liability to pay back the bank. So with stocks, if the company goes bankrupt or the company is valueless, you just lose your money. You don't have to pay anyone else anything. You have $0 left, which obviously sucks. But if the home is deemed valueless or significantly valued less and you need to sell it, you have to pay the bank back. So now that $500,000 house, say it's valued at $350,000, well, now you're a little bit underwater, right? And that's what happened in people in like 2011, 12, 13, but the thing is though, is only 7 years later, everything's back to normal, okay? So if you're only planning on holding a house for 2 years or something like that, that's not really a good investment strategy, right? You should at least be looking to hold on to it between 5 to 7 years. The other thing you have is a higher point of entry. We talked about that. You can't come in with, $5 and buy a stock, The higher carrying costs and maintenance. Now, like I was saying with stocks, they don't have any maintenance. You can't get a roof leak on your shares of Tesla. Now, unfortunately, with more risk comes greater reward, but it's risk nonetheless. So you might have to eat a good chunk of your earnings replacing an $8,000 roof. But the great part is you only have to do that every 15 years. All right. And then it is not easy to access capital. We discussed that. It costs money to access your capital. It's not even that it's hard to access. It costs you money. You have to sell the home and things like that. So to break it down, a lot of people, they say, well, what is your final answer? Which one do you prefer? So as far as long-term wealth, I prefer real estate, okay? And the reason for that is because it's just it's a great way to get residual income while it's like holding a stock that pays you every month, okay? Now, but don't get me wrong, holding stocks is very important too. So I have a retirement account that I contribute to every year, and then what happens is that's gonna be my retirement. It's a nice, stable, supposed to be stable, upward curve for that. But the other thing I do is, like I said with the Motley Fool, if I keep my own cushion, but I also take any excess money that I'm using to save up for real estate investment and I put that into the stock market. So if I have $10,000 extra sitting in my bank account, it is doing nothing for me. It is in the worst possible place, okay? But if I go ahead and put that into the stock market, yes, you have the ability to potentially lose a little bit of money, but your upswing, as long as you make calculated smart trades, your upswing, your chances of it going up are much better. So even if I make $500 off of that 10,000, it is still exponentially better than what it did in the bank, okay? So I think both of these asset classes are extremely valuable and extremely important, and it really just comes down to what your goals are. So, and that's about it, but I will talk to you guys next time. If you have any questions, post them and I'll get to answering them. Have a good one. Bye.